Boyne here with BK Securities. In this video, I want to talk about how I profit from market crashes, rapid price declines, and aggressive sell-off. And I want to talk about why this is actually an amazing opportunity and something that we shouldn't be feared of, but rather embrace when it happens, because it doesn't happen very often. And in terms of this video, we're going to kind of cover some of the factors and influencers of rapid sell-offs and aggressive market declines. And then we're going to talk about two different strategies that I use, both from a trading and investing perspective, and both from a perspective of making money in a short term while the market is going down, and then making money in a medium to long term. To do this, we're going to be looking at some live case studies and examples, in particular Nvidia and Meta, and I'm going to show you how I would profit from both of the strategies. So something to understand is that in the short term, markets are irrational. And to illustrate what I mean here is that if we look here, we have two charts. Both of the charts are of the S&P 500 index. The difference between them is that this chart is a 30-minute chart, meaning that each candle is a 30 minutes of price action, right? And you can see that this chart starts on the 12th of June and ends on August 5th, okay, of 2024. Now, on the right, we have a monthly chart, meaning that each candle is 1 month of price action. And this one is on a longer time frame, longer period. So from 1987 all the way to August of 2024. So what you'll see is that on the chart on the left, prices are irrational. They're not moving in any particular direction, right? We have prices going up, prices moving sideways, prices crashing down, right? We have gaps, all sorts of things that normally don't really tell us a particular long-term direction or anything like that, right? And then when we look at a chart on the right, we can see that over a longer period of time, kind of when you zoom out, right? When you kind of step away and look at the bigger picture, we can see that the S&P 500 has just been crushing returns for its investors, right? So you can see how in a short term, markets are irrational, and how over the long term, you can kind of see the bigger picture in terms of returns. In the short term, so when the markets are irrational, right, there are several things that are factors of this irrational behavior. And in particular, there are several things that causes prices to rapidly fall or markets to sell off. In the first place, what causes prices to fall is selling. Right? So when there's more sellers in a market and people are selling their shares, this is causing prices of stocks in particular to fall, for example, or any other security, right? And the more aggressive the selling is, the more aggressive these declines or falls in prices are, right? And they're usually denoted by red candles. Right? So these factors or influences, the key ones are market makers, high frequency trading or algo trading systems, the fear and panic selling. And then, we have margin calls. And you'll see that some of these act independently, but they usually cause a chain reaction where all four of these become activated. And then you end up with an aggressive sell-off. I've included the Investopedia definitions for you guys just so it's easy. So you can always pause this section and read the definitions, or go back to watch it a few times. But let me explain to you kind of how these things work together. So usually the first step is, there's a buyer out there who thought that the prices will continually going up, and then they kept on buying the stock, right? Or whatever security. And then at one point, the direction of that security price changed and now started going down. Now, this person who just purchased a whole bunch of this security likely used margin, right? And so what happens is that when the price rapidly declines, these buyers end up getting a margin call from their broker, meaning that they have to either top up more money into their account or sell existing positions to lower their margin amount, right? So if they can't top up the amount with more fresh cash, right, they end up having to sell positions. And when they see a rapid decline in something, they usually get out, right, to avoid further declines in profits, right? So they'll sell a bunch of their positions at this point. Okay, this will further amplify the selling effect, right? Then you have fear and panic take place because all of these traders around the world looking at the charts and they're seeing all of these red candles, right? And more of them are appearing. They're getting more aggressive, right? And fear and panic of people either, not locking in existing profits, or people who bought at the top, losing a whole bunch of money on their trades and investment. They start fear and panic selling. They end up driving the prices even further down. Then what happens is these high frequency trading software systems, algorithmic trading systems, they see a certain price action take place, right? They see rapid declines in prices. They see the volume of all these people selling, right? So now they kick in and they start, transacting thousands of transactions within minutes, basically. Of selling a particular security. That further increases the rate at which there's a sell-off, right? So there's even more sellers now, right? And then market makers join in because they're the ones that are, the people in the middle, basically, between buyers and sellers. So they start playing with bid and ask spreads to capitalize on the move down. Again, selling is created when the supply of shares, right, exceeds the demand. So when there's more sellers than buyers. And so you can see how when any of these things take effect, the other ones kick in, and then the selling is amplified and driving prices at even a faster rate down. Now, these, sell-offs can just be corrections, or they can, lead to bear markets, which we have seen in the past. And there's always reasons to sell. We see here a chart of the S&P 500 published by Ritholtz Wealth Management here, dated from March 09 to September 2021. Usually these sell-offs happen when there's some kind of a negative news or some kind of a bad economic report or something like that usually triggers that fear and panic in the markets, and then it triggers all of this selling action. We know that markets don't move in a straight line, right? They move, as you can see here, in waves, right? So there's always that wave up and wave down. Wave up is when people are optimistic. Wave down is when people are fearful and they panic, right? So usually when these, you can see here that all of these events here cause these little dips in the chart. But overall, you can see that for people that held their investment for a long period of time, in particular the S&P 500 here, they've managed to get quite a bit of return on their money, right? So over a long period of time, the markets will go up, right? But in the short term, they're irrational. Anything could happen. So knowing this, how do you profit in this kind of market? Because a lot of people end up getting fearful and they either stay out of the markets or get scared and exit all their positions or something along the lines of that, right? So how do we profit from this type of a situation? Because we all know how to profit when prices are going up. So during the market crash or rapid decline and sell-off, I use mainly two ways to profit in the market. One way here you will see is focused on earning short-term profits, usually weekly or monthly, while the sell-off is happening, right? During the timeline of the sell-off, I generate profits as the prices are going down. And this is more of a trading perspective, right? Now, on the other side, I take more of an investment perspective, the medium to long-term perspective, right? And the second way I make money from these types of events is when these sell-offs happen rapidly, they're irrational, right? And often they drive prices of securities way below their intrinsic value or their fair value. When a stock is under its fair or intrinsic value, it means that it's undervalued. It means it's cheap. On the opposite side, when it's overvalued, right, it's above its intrinsic value, right? And it's expensive. So we want to buy stocks when they're cheap. So then eventually when the market wakes up from all the irrational thinking and the prices starts flying up, towards their real values and higher, right, to the expensive territory, so to speak, we can profit from these price increases and from capital gain. Now, the trick with these, right, is we want to accumulate only when the prices are under the fair value. So we're getting them essentially at a discount, right? And the bigger the discount, the bigger the margin of safety for your investment, right? Because the more of a deal you get, the better you're going to come out once the stock actually starts moving up. Now, the trick with this, with both of these ways, is to look at a few things. So going back to the, earning money as a short-term profit cash flow sort of thing while, the decline is happening, the way I do that is I go short, right? I short the market. Now, the way I short the market, whether it's, stock or any given security, I buy put options. And as the markets go down in prices, my put options go up in value. So at some point I can sell this contract again in the market and make a whole bunch of money, okay? And they usually provide very fast and magnified profits. And I'll show you later in detail examples when we look at Nvidia, how this actually plays out. Now, when it comes to that whole investment medium to long-term side, right? The key is to accumulate and buy only fundamentally strong companies with large competitive moats and hold them for that medium to short term. Now, what is a fundamentally strong company? A fundamentally strong company is a company, that has consistently increasing revenue, has a whole bunch of, increasing cash flow. The balance sheets are looking really well, right? It's got a good brand and reputation, right? So, and then the competitive moat is essentially a barrier that this company has around it that prevents other competitors from the marketplace, similar companies, right, coming in and taking market share and customers off this said company. An example of a company like this would be Apple. Apple is always profitable. It's constantly making more and more money and becoming more and more efficient, innovating more and more. The brand is growing and everything else, right? And it has a competitive moat. Like once you start using Apple products, you go into their Apple sphere of services, basically, right? And you can't just bring a Microsoft phone if you have all other Apple devices. It just, the syncing and everything wouldn't work too well, right? So once you're an Apple customer, it's kind of hard to switch away. So that's an example of that. And I want to accumulate Apple, for example, as it becomes cheap and goes, below the intrinsic or fair value. Okay, so now let's dive into the actual examples. So here we're looking at a couple of things here. We are looking at a chart of Nvidia, okay? And in particular, this is a monthly chart. So each one of these candles of price action is 1 month, right? And we can see that we're all the way basically from July of 2017 to basically August of 2024. So how would I now execute my strategy on this, right? So there's two ways to think about this. First, let's talk about that medium to long-term investment sort of strategy. On this one, the key that we need to know is we need to know what the company's fair or intrinsic value is. And we see that as of August 5th, Nvidia's fair value or intrinsic value was $89.53 per share, okay? And if we look at a chart, right, we can see that the current price is at 107.27, right, which we can see here as well. This means that Nvidia is not cheap right now. It's expensive. It's above the fair or intrinsic value. So it is an overvalued company. And we can see that it is almost 20% overvalued, right? So would I buy and accumulate Nvidia shares here? No, I would wait until it goes to the fair value or below it. And you can see here on the chart of Nvidia, I've put a horizontal line here, the fair value line, and you can see where that 89.53 price is. So naturally over time, stocks tend to go, or any type of securities, to their intrinsic or fair value, right? And we can see that happening right now. And we've seen it happen before. You see here that if you bought Nvidia in 2024, at the beginning of 2024, you would have paid approximately about $50 per share. And that is way below the current intrinsic value, right? So this is why the price was pulled up to the intrinsic value, became fair, right? And then it went expensive. And this is usually how it happens, right? So now Nvidia is pulling back, and we're hoping that it will pull back to the fair value or its intrinsic value, so we can start accumulating its shares. And we're going to accumulate shares at certain support levels as it goes down, right? And allocate them to our portfolio. And then hopefully when Nvidia inevitably hits some sort of support, wherever it may be, whether it's this line right here or down here, okay, it's going to hit that and go back up. And now we're going to essentially end up profiting from the entire price increase wave up back to its fair value and then back to the expensive territory. And usually it will break the high. So it might end up at 150, 160. Right? Or even way higher than that, right? So, but the idea is to purchase and accumulate at or below this line. The more below, the bigger of a margin of safety you have there, okay? So that's the goal. That's how we would do the strategy from a medium and long-term perspective. So I accumulate these fundamentally strong companies when they're cheap, when they're undervalued, And then once they inevitably go back to fair value and into higher than fair value, like the expensive territory, I sell at the height and lock in my capital gains or my profit from the trade. Now let's talk about, this same example. Let's look at Nvidia, but now let's talk about how I would trade this while these red candles are forming and developing, while it's moving down to its fair value, right? Because I don't want to just sit essentially and wait and waste time, weeks on end or whatever amount of days it takes for it to go down here or below so I can start buying and profiting from the other strategy. I want to make money on the way down, right? And as long-term investors or medium-term investors, we don't have the luxury necessarily of profiting from the prices going down, other than accumulating them when they're cheap. But as traders, we have the ability to profit and bet on the market prices going down and profit from those decreases. So we make money every day, every week, every month, so to speak. So how would I take this from a trading play? How would I take this from a trading perspective? Well, let's assume that, at this point here, someone said, hey, Nvidia has had a massive, run up and it's getting pretty expensive. It's way above its fair market value. And I don't feel comfortable buying here. And then let's think that a lot of the market started thinking like that, and then buyers disappeared. So all was left was these sellers, right? People who wanted to lock in profits from these massive runs up, and people who are attacking the stock to short it and whatnot, right? So let's say you decided that on this day here, you decided to short Nvidia. Okay, after you saw this candle kind of whittle down into a somewhat of a more bearish than bullish candle. How would you play this from a trading perspective? You could short Nvidia, right, with stocks, but that would be more capital intensive and more risk related, right? So how would I do it? Through options. How do I short it? Through puts, right? If we imagine that you short it right around a 140 price. So if you look at our example here, we'll see the option chain for Nvidia here, okay? And I've circled here two things, okay? The one thing that I've circled here is to show you that the last price of Nvidia was 106.73. And this option contract is for 106. It's something that we call at the money, okay? Without going into too much with options here, I just wanted to kind of show you everything. You can learn a lot more about this on my website and through some of my courses and whatnot. But let's say, this 106, because that's essentially where the price was, this is called at the money, right? So if we look at our example here, if we pretend we go back in time and we're at the top here, right? At the money would be around that 140 price, right? Because you would be at the money. What does that mean? So this would mean that when you bought the contract, when you bought the put option, you would have been there, okay? And this would have said 140, right? Now the prices would likely be somewhat similar. So let's say, this contract prices here, you can see the cheapest price is $3.95, right? And the most expensive is $4.10, right? Now this is per share, and in every contract, there's automatically 100 shares. So this really means $395 the cheapest, $410 is the most expensive, okay? And so let's say you wanted to buy the put contract, right? And let's say you bought it at just the mid price, like you didn't want to bargain or anything like that. You just wanted to get it at a mid price basically. And you bought that contract, right? So it would have been $4.03 per share, but we know you're controlling 100 shares with every option contract. So the cost of this contract to you would have been $403, okay? That was the capital required for the trade, right? And then let's say you did that, right on that date when Nvidia started turning down. So you would have paid $403. Now we fast forward to, here, which is where the market closed last Friday, right? And when you fast forward to there, now you can see this option chain here. You can see what the 140 is worth today. So you would have bought this 140. This would have been all the way up here, and you would have purchased it at some of these rates. And now your 140, after Nvidia's decline for the last two red candles, for example, your 140 contract now is actually worth anywhere from 32.10 to 33.45. And don't forget, this is multiplied by 100. So it's actually 3,210 to 3,345, and it only cost you $403 for that contract initially. So your contract is increased in value, right? And now on an open market, you can sell for this much. You can close your contract for and you get this much, right? So if I sold my contract, and let's say I took the mid price again, right? That would mean I sold the contract for $3,278, okay? Which leaves me with a profit, right? On this trade, because I bought it for 403 and I sold it for 3,278, a massive gain, right? So in particular, a profit of $2,875, right? So that is a 714% return, right? So about 7 times your money. And this took 30 days. This is a nice monthly income trade, right? So this is how you can profit by trading put options, for example, by buying puts when the markets are falling, and then before you think the price will, reverse. So you could hold this put, all the way down to hits like the fair market value, for example, and then that put will probably be worth like $7,000 to $8,000, if not even more at that point, maybe even 10 grand, right? On $400, which is just crazy returns, right? This is why options are lucrative. And again, you can learn a lot more from some of the other content that I have in courses, right? But you could also close that put right now, for example, and lock in your profits and then open another put after. But the idea is to close the put before you think the price will go up. So you realize the most profits on that, right? And then you prepare for the other strategy, which is to start accumulating, provided that the price drops below the fair value or intrinsic value. This was an example of Nvidia, which is currently overvalued, right? And this was an example how you could trade and make profits in a short term by buying put options when markets are crashing. Now, what I want to show you here is an example of a company that's actually undervalued. So the company that I'm talking about here is Meta. We have, a chart of Meta here, and it's a monthly chart. So each one of these candles is 1 month of price action, right? And we can see it runs from approximately 2015 all the way to 2024. We can see that Meta has, dropped quite a bit down actually below its intrinsic value back in, 2021, 2022 timeframe. And then once the market kind of woke up, it just drove the price all the way back and some, right? This is what we're talking about. So ideally, if you were, back in 2021 and Meta was falling in price, right? And at that point, you would have calculated your intrinsic value and you were like, okay, I know what the intrinsic value is. I'm going to buy once it goes below it. So say its intrinsic value is here, right? You would have accumulated shares all the way along here. And your average price would be somewhere here, right? So once that stock turned around and started, doing this, you would have locked in amazing profits on this. But what I want to show you here is that at current levels where, we see here that the close on Friday was 488.14, right, which is the current price. And the fair value of Meta, right, is actually 652.06 cents. So unlike Nvidia, this is actually undervalued by 25%. So adding Meta shares at any point would be a good idea, because sooner or later, Meta will reach and exceed its market value here, okay, which is 25% higher as of current levels. So now if Meta pulls back, right, maybe to the support level here, right, maybe it's a good time to add shares. So then once it reverses, you can lock up profits all the way up, and then, it's probably going to go into expensive territory. So who knows where it could end up? It could be at $800-900 a share at some point, right, when it's expensive. So I just wanted to show you. Now, would I buy it here? I don't know. I would either wait for to see if there's a breakout on this, right? In which case, yeah. But if it starts pulling back, then I would wait till we hit some sort of a support level before I accumulate the first set of shares. And so this is how you make money during, the sell-offs and aggressive, market crashes, which most people are fearful. But if you realize where the opportunities lie, you can position yourself where you can make short-term profits and long-term profits at the same time, right? And experience great returns on your investment accounts and capital. Again, thank you for watching. I hope it helped. If you like this video, you can follow the channel, like the video, subscribe and get those notification bells. So every time I pull one of these out, you can kind of get notified and then you can look at it. Hopefully it's in the same time that you're making your decision. So maybe it can help at some point. Hopefully you enjoy this. We'll see you in the next one.